Most traders lose money on the exact same pattern professionals use to build fortunes. The golden cross. You've seen it 1,000 times. The 50-period moving average crossing above the 200. Everyone knows it. Every textbook celebrates it. Every retail forum screenshots it like a trophy. Yet amateurs enter too early, and professionals wait for something else entirely. Here's the brutal truth that no trading educator will tell you. 90% of traders who buy a daily golden cross will lose money on that trade. Not because the pattern is wrong, but because the timing is catastrophically late. By the time the daily golden cross prints, the smart money has been positioned for weeks, sometimes months. The stock has already rallied 20 to 30% off the bottom. You're not buying the start of a trend. You're buying exhaustion, not ignition. You're providing liquidity for institutions to exit gracefully. Think about the mathematical reality of what has to happen for a daily 50-period moving average to cross above the 200. The stock has already rallied. Substantially. That's how averages flip. Price has to trend first, for weeks, before the slower average catches up. So when you buy that signal on the daily chart, what are you really doing? You're buying into a move that's already well underway. Someone is selling to you, and that someone is not another confused amateur. It's the professional who started building a position quietly, weeks earlier, when the chart still looked boring and the news was still skeptical. This creates what I call the lag trap. The pattern everyone celebrates as bullish is often the exact moment the easy money has already been made. The retail trader sees the cross, reads it as confirmation, and enters with conviction. The institutional trader sees the same cross, recognizes distribution opportunity, and begins to lighten positions. One is buying hope. The other is selling reality. Jesse Livermore never had moving averages on his tape. He didn't have colored lines on a screen or charting software. But he had something infinitely more valuable, a timing mechanism that told him exactly when resistance was breaking and when the line of least resistance had shifted in his favor. He waited for what he called the pivotal point. Not a magic level drawn after the fact, but the precise moment when a stock stopped acting weak and started acting strong. Livermore was obsessed with this concept because he understood something most traders never learn. Markets reward observation, not prediction. He didn't try to guess bottoms. He famously said that trying to catch bottoms was a fool's game that ended in the poorhouse. Instead, he waited. He watched the tape for signs that selling pressure was exhausted and buying pressure was taking control. Only when he saw that evidence did he commit capital. The 1-hour golden cross is that pivotal point mechanism translated into modern terms. It sits in the sweet spot between the noise of intraday charts and the lag of daily signals. It gives you the pivotal point before the crowd sees it. While amateurs stare at the daily chart, waiting for lines to cross 3 weeks from now, professionals watch the 1-hour chart today. They see the 1-hour 50 cross the 1-hour 200 inside a larger daily structure. They see ignition while others see history. Amateurs see the daily cross and pile in at the top of the first wave. Professionals see the 1-hour cross confirm inside a larger daily setup and enter with confirmation, not hope. They're not guessing where the stock will go. They're responding to where it's already going. One approach is prediction. The other is participation in a confirmed movement. Let me anchor this with the trade that made Livermore legendary. In 1915, he stalked Bethlehem Steel like a predator watching prey. The stock was building a base around $40. Amateur traders were jumping in and out, trying to scalp quick profits, or shorting because they thought it had run too far. Livermore did nothing. He sat on his hands. He waited for weeks, watching the stock test resistance levels again and again. He didn't suffer from fear of missing out. He suffered only from fear of being wrong. He watched how the stock behaved around key levels. Were the pullbacks getting weaker? Were the rallies getting stronger? Was the selling drying up? He waited for the tape to prove the trend was real. When Bethlehem Steel finally broke through his pivotal point with authority and refused to fall back below, that was his confirmation. Not his prediction, his observation of a shift that had already occurred. He didn't just buy. He bought with conviction. Then, as the stock continued to prove his thesis correct, he pyramided. He added more at higher prices, but with less risk, because the stock was now demonstrating that the line of least resistance had turned upward. He rode that position from $40 to $600. That's not a trade. That's a campaign. A systematic extraction of profit from a confirmed trend. This is the identity shift that separates amateurs from professionals. Amateurs think trading is about prediction. They believe the goal is to look at a chart and guess where it will go. So they buy blindly at support, hoping it holds, or they buy late on daily crosses, hoping momentum continues. They operate on hope, excitement, and fear. Professionals know that trading is about observation and confirmation. They understand that if you wait for the market to show its hand first, you can respond with mathematical precision rather than emotional guesswork. The 1-hour golden cross forces this discipline. It demands that you wait for short-term momentum to align with intermediate-term structure. You cannot enter just because a stock looks cheap or because you like the company. You must wait for the cross. This simple rule eliminates the urge to catch falling knives and saves you from buying dead money. The 1-hour cross operates on a different frequency than daily signals. It catches the transition from base to breakout in real time. It shows you when institutional accumulation is shifting into markup phase. It gives you the entry point that smart money used weeks before the daily signal prints. You're not late. You're early. And in trading, being early with confirmation is everything. This script will show you exactly how to use the 1-hour golden cross as your entry trigger, not as a standalone signal, but as the final piece of confirmation inside a larger structure. You'll learn why waiting for this cross saves you from false starts, why it aligns you with institutional flow instead of against it, and why Livermore's principles of patience and confirmation are baked into this one simple pattern. But you must understand this is not magic. The 1-hour golden cross will not eliminate losses or make every trade profitable. What it will do is shift the odds in your favor. It will give you a repeatable, mechanical edge that removes guesswork and replaces it with observable evidence. You're no longer predicting, you're responding. However, a 1-hour cross in isolation is just noise. If you apply this blindly to every stock you see, you'll be chopped to pieces by algorithms and false breakouts. Context is everything. The 1-hour cross is the key, but the daily chart is the door. You need to know which doors are worth unlocking. But first, you need to understand why the amateurs fail at this exact same setup. Because if you don't know the traps, you'll fall into every one of them. You'll see the cross print and think it's a standalone signal. You'll enter without checking daily structure. You'll size too big because you're excited. And you'll blame the pattern when the real problem was your execution. The difference between a profitable trader and a broke trader is often not the strategy itself, but the nuance of its application. The amateur looks for signals. The professional looks for the context that makes signals valid. That's what we'll dissect next. The specific mistakes that turn this powerful timing tool into a wealth destruction machine. Here's what happens to the amateur trader, and it happens with painful predictability in every market cycle. They pull up a daily chart and see a stock starting to wake up. The 50-day moving average is curling upward toward the 200. Every trading book they've read has drilled one idea into their head. Golden cross equals bullish. Excitement builds in their chest. They feel the momentum coming. They want to be early, to catch the move before everyone else sees it. So they jump in before the cross actually prints. They feel clever, like they're front-running the obvious signal. For 2 days, the trade works. The stock pushes a little higher. Then it stalls. For the next 3 weeks, price grinds sideways in a tight, frustrating range. Every morning they check the chart, hoping today is the day it explodes. Instead, it chops them up with 2% up days followed by 1.5% down days. Their stop loss gets tested repeatedly. Finally, on a random Tuesday morning, the stock gaps down on no news and stops them out for a 5% loss. 2 weeks later, the daily golden cross finally prints. The exact signal they were waiting for originally. The stock rips 12% in 3 days. They watch from the sidelines, kicking themselves for getting shaken out right before the move. This is the first trap, entering too early without proper confirmation because you're afraid of missing out. But there's a second trap that's even more destructive, and it catches the traders who think they've learned from the first mistake. The amateur decides to be disciplined this time. They tell themselves they won't enter early again. They'll wait for the daily golden cross to confirm. They'll follow the rules exactly as written. So they wait. A different stock, same setup. The daily 50 crosses above the daily 200. It prints clearly on the chart. They enter with confidence, believing they've followed proper protocol. This is the confirmed breakout everyone talks about. The stock rallies 2% on the day of entry. They feel vindicated. They were right to wait for confirmation. Then the stock pulls back. 3% the next day. Another 2% the day after that. By the end of the week, they're down 8% from their entry. The pain becomes unbearable. This clearly isn't working. The pattern failed them. They sell, locking in the loss, promising themselves they'll find a better setup next time. The stock consolidates for 2 weeks. It builds a tight range just below where they entered, shaking out the last of the weak hands. Then it explodes. It doubles over the next 3 months. They watch the entire move from the sidelines, bitter and confused, convinced the market is hunting them personally. This is the second trap, entering on lagging confirmation, getting shaken out by normal consolidation, and missing the actual trend. Both mistakes stem from the same fundamental misunderstanding of timeframes and confirmation. The problem isn't the golden cross pattern itself. The problem is that the daily golden cross is a lagging indicator by mathematical design. It's not telling you a trend is about to start. It's telling you a trend has been underway for weeks, possibly months. Think about what has to happen mathematically for a 50-day moving average to cross above a 200-day moving average. The stock has to rally substantially for an extended period. The 50-day average represents the average closing price over the last 50 trading days. For that average to rise enough to cross above the 200-day average, which itself is much slower to respond, price has to trend upward for weeks. The mathematics of moving averages guarantee this lag. By the time the daily cross prints, you're not early. You're late. The first leg of the move has already played out. Early institutional buyers are sitting on 20 to 30% gains. You, stepping in on the daily signal, are often providing them with exit liquidity. You're buying their profits. The cross you're celebrating as bullish confirmation is often the exact moment smart money begins distribution. This creates what I call the lag trap. The pattern everyone celebrates as a buy signal is frequently the moment when the easy money has already been made. The retail trader sees the cross, reads it as confirmation, and enters with conviction. The institutional trader sees the same cross, recognizes a distribution opportunity, and begins to lighten positions. One is buying hope, the other is selling reality. The 1-hour golden cross operates on an entirely different frequency. It's not a lagging indicator of a mature trend, it's a leading confirmation tool inside that larger trend structure, telling you when the next leg is starting. It catches the transition from accumulation to markup in real time, not 3 weeks after it's already happened. Jesse Livermore understood this principle without ever seeing a moving average on a screen. He called it, waiting for the line of least resistance to reveal itself. He didn't try to predict which direction a stock would go. He observed how it was already moving and waited for confirmation that the movement had conviction behind it. When a stock broke above what he identified as a pivotal point and held that break, refusing to fall back below, that was his signal. The line of least resistance had shifted. Buyers were in control. When it failed to hold, when the stock broke the pivotal point but immediately fell back below, he stayed out. The line of least resistance had not actually shifted. It was a false break. Sellers were still in control. He didn't argue with the tape. He didn't hope it would come back. He simply observed what was happening and responded accordingly. The 1-hour golden cross is that pivotal point concept translated into modern technical analysis. When the 1-hour 50 crosses above the 1-hour 200, it's confirming that short-term momentum has shifted decisively bullish within the context of intermediate-term structure. It's not predicting the future. It's confirming a shift that has already occurred at the intraday level but hasn't yet been reflected in daily indicators. Let me anchor this with mathematical precision using a real example that demonstrates the power of this timing advantage. In late 2020, Tesla was basing after a massive run that had taken it from $80 to nearly $500. The daily chart looked messy. It had pulled back, consolidated, and was building a platform around $400. Amateurs were doing what amateurs always do. Some were trying to catch the exact bottom, getting stopped out repeatedly, while others were waiting for the daily golden cross to give them permission to enter. Professionals were watching a different time frame entirely. On November 9th, 2020, the 1-hour 50 period moving average crossed above the 1-hour 200 period moving average. This happened while the daily 50 was still well below the daily 200. The daily chart showed no golden cross. It showed no clear bullish signal that retail traders would recognize. But the 1-hour chart was confirming that short-term momentum had turned decisively bullish. Tesla was trading at $420 at that moment. A professional watching the 1-hour cross would have entered there with a tight stop below the recent consolidation low. Within 6 weeks, Tesla hit $700. That's a 66% gain. 420. 7,040. Collar 0.667, 66.7%. The daily golden cross didn't print until mid-December, by which point Tesla was already trading in the mid-600s. The easy money, the low-risk entry with maximum upside, was already gone. Retail traders who waited for the daily confirmation entered 40 to 50% higher than professionals who used the 1-hour cross. They bought at 600 when they could have bought at 420. They took on more risk for less reward. This is the fundamental identity difference. The amateur enters on hope or enters on lagging confirmation. They're always either too early without confirmation or too late with confirmation. The professional enters on leading confirmation within proper structure. They're early with confirmation. That timing advantage compounds into massive differences in returns over time. The amateur hopes the support holds. They hope the earnings are good. They hope the daily cross works this time. The professional enters on confirmation. They don't hope, they observe. They know that the 1-hour cross signifies a shift in market structure. They know that the probabilities have tilted in their favor. They know that if the trade fails, they'll know quickly and lose small. But here's the critical nuance that separates profitable use of the 1-hour cross from catastrophic misuse. You cannot use it in isolation. That's the trap that destroys sophisticated amateurs. They learn about the 1-hour cross and immediately start scanning for it on every chart. They see a cross print and they enter without context. The stock fakes them out. They lose. They blame the pattern. The 1-hour golden cross is not a standalone signal. It's a timing mechanism within a larger structure. If the daily chart is in a downtrend, the 1-hour cross is noise. If the daily chart shows no base, no consolidation, no clear zone of resistance being tested, the 1-hour cross is a trap. You need the daily structure to be right first. The daily chart tells you which stocks are worth watching. The 1-hour chart tells you when to enter. This is the discipline Livermore practiced religiously. He didn't just look for pivotal point breaks. He looked for pivotal point breaks in stocks that had built proper bases, that had established clear zones of resistance, that had shaken out weak hands through consolidation. Only then did he care about the pivotal point. Only then did the break mean something. The same principle applies here. The 1-hour golden cross only matters when the daily structure is coiled and ready, when the daily chart shows a stock that has been basing for weeks, building energy, testing resistance, and preparing for a breakout. In that context, the 1-hour cross is your precision entry trigger. Without that context, it's just another false signal in a sea of noise. And that's exactly what we'll cover next. The specific daily structure that must be in place before the 1-hour cross even matters. The setup that separates high probability entries from low probability traps. Because if you don't know what to look for on the daily chart first, the 1-hour cross will destroy you just like every other misapplied signal destroys traders who chase patterns without understanding context. The 1-hour golden cross is worthless without the right daily setup. Completely worthless. This is where sophisticated amateurs blow themselves up spectacularly. They learn about the 1-hour cross, understand the logic behind it, and think they've discovered the Holy Grail. They immediately start scanning every chart for the pattern. The moment they see the 1-hour 50 cross above the 1-hour 200, they think they've found gold. They enter without hesitation, convinced they're early to a major move. The stock rallies for half a day, then reverses violently. They get stopped out. They try again on another stock. Same pattern, same result. After 3 or 4 losses, they conclude the 1-hour golden cross doesn't work. They abandon it and go searching for the next indicator. They never realized the problem wasn't the pattern. The problem was context. They were using a precision timing tool on a broken foundation. Here's the harsh reality most traders learn only after paying expensive tuition to the market. A signal without context is just noise. You cannot use a tactical trigger if the strategic map shows you're walking into a minefield. Professional traders understand this hierarchy. The daily trend is the general. The 1 hour cross is just a captain. You never follow the captain if the general is marching in the opposite direction. Professionals never enter on a 1 hour signal unless the daily chart is coiled and ready to explode. They respect the hierarchy. They demand that 4 specific elements align on the daily chart before they even glance at the 1 hour time frame. Not 3 elements, not 2, all 4. This is non-negotiable. First, you need a stock that has been basing for at least 3 to 6 weeks, not 3 to 6 days. Weeks. This time frame is critical because time is the mechanism that shakes out weak hands and transfers ownership from the impatient to the patient. When a stock consolidates sideways for weeks, impatient traders get bored and sell. Fearful traders get scared and sell. Who buys their shares? Institutions. Strong hands. This basing period represents the fuel for the next move. Without this base, there's no foundation. A stock that rallies without a proper base is running on fumes. When it pulls back, there's no support structure underneath it. It falls through air. Second, you need a daily 50-period moving average that is flattening or starting to curl upward, not declining steeply, not pointing straight down. If the daily 50 is falling, the stock is still in an intermediate-term downtrend. Any 1 hour golden cross that prints in that environment is a counter-trend signal fighting against the larger flow. You're trying to catch a falling knife, and the probabilities are stacked against you. When the daily 50 flattens, it tells you the rate of decline has stopped. When it starts to curl upward, it tells you momentum is shifting from bearish to neutral to potentially bullish. You don't need the daily 50 screaming upward. You just need it to stop pointing down and start showing signs of life. Third, the daily 200-period moving average must be flat or rising, not falling. This matters more than most traders realize. If the daily 200 is declining, you're dealing with a stock in a long-term downtrend. The structural headwinds are immense. Every rally will be sold into, every breakout will be faded. A falling 200 represents a massive weight on the stock, where the average holder is underwater and looking to sell at break-even. But when that 200 is flat or rising, you're not fighting against the larger current. You're waiting for the smaller time frames to align with the larger time frame. When that alignment happens, the probabilities of a sustained move increase dramatically. Fourth, and most importantly, the stock must have built a clear, undeniable zone of resistance and must now be testing that zone. Resistance is where prior rallies have failed. It's where sellers have previously overwhelmed buyers. It's the line in the sand that separates a basing stock from a breaking out stock. Without clear resistance, you have no reference point. You don't know what break would be significant. You're trading in a fog. But when a stock has tested a resistance level multiple times, when it has built a clear ceiling it cannot penetrate, that level becomes incredibly important. Every test of that resistance is a battle between buyers trying to push through and sellers trying to hold the line. This is exactly what Jesse Livermore meant by the line of least resistance. He understood that stocks don't move randomly. They move along paths of least resistance, and those paths are determined by where supply and demand are concentrated. When a stock is below resistance, the line of least resistance is sideways or down, because there's a ceiling of supply above. When a stock breaks through resistance and holds, the line of least resistance shifts upward, because the ceiling has been removed. Livermore was obsessed with this concept because he understood something most traders never learn. Markets reward observation, not prediction. He waited for stocks to prove they could break through resistance and hold above it. He didn't try to predict the break. He didn't enter before the break hoping to be early. He waited for confirmation. Only when the stock broke resistance, held above it for several days, and refused to fall back below did he commit serious capital. That confirmation told him the line of least resistance had genuinely shifted. The battle had been won. Buyers were in control. The 1 hour golden cross is your modern confirmation mechanism for that exact same principle. When a stock breaks above resistance on the daily chart, and the 1-hour golden cross prints simultaneously, you're seeing real-time confirmation that the breakout is backed by momentum. You're not guessing whether the break is real. You're observing evidence that short-term momentum has shifted decisively bullish at the exact moment the stock is clearing a critical level. Let me walk you through a perfect example that demonstrates how all these elements come together. In early 2021, Nvidia was basing between $500 and $600. The stock had rallied hard in 2020, pulled back, and was now building a platform. The daily 50-period moving average was flat, no longer declining, but not yet rising aggressively. The daily 200 was rising slowly, confirming the long-term trend remained intact. Resistance was crystal clear at $600. The stock had tested that level repeatedly and failed each time. Amateur traders were trying to catch the breakout every single week. They'd see the stock rally to 590, get excited, and enter, expecting it to blast through 600. Instead, it would hit 595, stall, and reverse back to 570. They'd get stopped out. 2 weeks later, they'd try again. Same pattern. Enter at 585, stopped out at 565. Over and over, the stock was grinding them down with false signals and failed breakouts. On February 8, 2021, Nvidia broke above $600 on significantly increased volume. This wasn't a weak, tentative push above resistance. This was a powerful move with conviction. And on that exact same day, the 1-hour 50-period moving average crossed above the 1-hour 200-period moving average. That was the signal, not the daily golden cross, which wouldn't print for weeks. The 1-hour cross confirmed in real time that the breakout above resistance was backed by genuine momentum shift. A professional watching this setup would have entered at 600 to 610, right as the break was confirming. The stop loss would sit just below the breakout level, probably around 580 to 590, giving the trade room to breathe but protecting against a failed break. The risk was tight. The reward was the entire trend that was potentially starting. Nvidia went from $600 to over $800 in 6 weeks. That's a 33% gain. 600. 8,600. Cells, 600. 200, 0.333 cells, 33.3%. The daily structure told you the stock was coiled and ready. The resistance level told you what break would be significant. The 1-hour cross told you exactly when to enter. All 4 elements working together created a high probability, low-risk entry point. Without the daily base, the 1-hour cross would have been noise. Nvidia could have printed a 1-hour golden cross at any point during its decline, and every single one would have failed because the daily structure was broken. But with the daily base in place, with the moving averages flattening and curling, with resistance clearly defined, the 1-hour cross became a precision entry tool. Here's the rule you must internalize, and it's non-negotiable. Never enter a 1-hour golden cross unless the daily chart shows a flat to rising 50, a flat to rising 200, and a clear test of resistance. If any of those elements are missing, the setup is incomplete. If the daily is in a downtrend, ignore the 1-hour cross entirely. It's a trap designed to take money from impatient traders who chase patterns without context. If the daily 50 is declining, the 1-hour cross is fighting the intermediate trend. If the daily 200 is declining, you're fighting the long-term trend. If there's no clear resistance being tested, you have no reference point for what constitutes a significant break. All 4 elements must be present. This is not optional. This is the foundation that separates profitable traders from broke traders. Waiting is a position. This is one of Livermore's most powerful maxims, and most traders never understand it. They think doing nothing is wasting time. They think they need to be in a trade at all times to make money. Livermore understood the opposite. He made millions by doing nothing until the setup was absolutely perfect. He sat on his hands for weeks, sometimes months, waiting for all the elements to align. When they aligned, he struck with conviction. When they didn't align, he waited. He didn't force trades. He didn't chase. He didn't enter marginal setups because he was bored. He waited for perfection, and when perfection appeared, he loaded up. That patience, that discipline to do nothing until everything was right, was the foundation of his fortune. He famously said, "It was never my thinking that made the big money for me. It was always my sitting." You must adopt the same discipline. The 1-hour golden cross will print on dozens of stocks every week. 90% of them will be traps, because the daily structure is wrong. Your job is not to trade every 1-hour cross you see. Your job is to identify the stocks with perfect daily structure, then wait for the 1-hour cross to give you the precise entry timing. Now you understand the complete structural foundation. You know the 4 elements that must align. You know why each element matters. You know the traps that destroy amateurs who ignore this structure. But knowing the setup is not enough. You can identify the perfect trade and still lose money if you botch the execution. There's one more critical layer: how to actually enter the position, how to size it properly, and how to manage it once the 1-hour cross prints. Because even with perfect structure and perfect timing, poor execution will destroy the edge completely. You've identified the daily base. You've watched the stock test resistance multiple times over weeks. You've seen the 1-hour golden cross print exactly as price breaks above that critical level. The setup is perfect. The structure is aligned. The signal has triggered. Now comes the moment where most traders, even sophisticated ones who understand structure and timing, completely destroy the entire edge, the entry and position sizing. Amateurs treat this moment like a lottery ticket. They see the setup, recognize its high probability, and slam into the position with maximum size. They risk 5, sometimes 10% of their entire account on a single trade. They convince themselves the setup is too good to fail. There is no defined stop-loss plan. Or if there is one, it's placed at some arbitrary level that makes them feel safe, not where the trade actually breaks down. Their approach is pure hope disguised as analysis. Professionals do the exact opposite. When the 1-hour golden cross fires inside perfect daily structure, they don't think, "This can't fail." They think, "This is where I begin the test." They know that no matter how good a setup looks, the market owes them nothing. So they approach the entry like a scientist running an experiment, not a gambler going all in on red. Here's the Livermore-style entry protocol for the 1-hour golden cross, and this is where your identity as a trader either evolves or stays stuck forever. You do not enter with your full position size. You enter with a probe position, 10 to 15% of your intended full size. That's it. Just enough to participate in the move if it works. Not enough to get seriously hurt if it doesn't. Your stop loss sits just below the recent swing low or just below the breakout level, whichever is tighter and more logical. Not some random percentage. Not 5% below entry because it feels safe. Your stop belongs where the trade thesis actually breaks down. If price returns into the base and loses the breakout level decisively, the breakout has failed. The line of least resistance hasn't shifted. Your hypothesis is wrong. You exit. Jesse Livermore never bet big on the first entry, and this discipline saved him repeatedly throughout his legendary career. He called it testing the waters. When a stock crossed his pivotal point, he didn't immediately throw his entire bankroll at it. He entered small, watched the tape with obsessive focus, and pyramided only when the stock confirmed the trend through its behavior. The 1-hour golden cross is your modern test the waters signal. It is not a signal to go all in. It is a signal to start building a position with precision and mathematical discipline. The cross tells you short-term momentum has shifted favorably. Now test whether this shift has conviction behind it. Here's the mathematical framework for your initial position sizing on the probe entry. P initial. Dup golfs. D.2R. Where? P initial is your initial position size in shares, R is your total dollar risk budget for the entire trade, and D is your stop-loss distance in dollars per share. The 0.2 ensures you're risking only 20% of your total planned risk on the initial probe. Let's break this down with concrete numbers. Assume you're trading a $100,000 account and you're willing to risk 1% on this trade. That's $1,000 of total risk budget. The 1-hour cross triggers as the stock breaks out at $50 per share. Your stop loss sits at $48, just below the breakout level. Your stop distance is $2 per share. Using the formula, P initial. Clux 2.21 thousand. Clux 2, 200. Clux 100 shares. You enter with 100 shares, committing $5,000 of capital. But you're only risking $200 on this probe, which is 20% of your $1,000 total risk budget. If the stock immediately fails and stops you out, you lose $200. That's manageable. That doesn't damage your account or your psychology. Now let me walk you through how this plays out using a real example. In mid-2021, Shopify was basing around $1,400 after consolidating for weeks. The daily 50 was flat, no longer declining. The daily 200 was rising slowly. The stock had built clear resistance at $1,450 and was testing that level repeatedly. Amateur traders were getting chopped up trying to catch the breakout, entering too early and getting stopped out on false signals. On June 15th, the 1-hour 50 crossed above the 1-hour 200 as price broke above $1,450 on significantly increased volume. That was the trigger. A professional following this protocol would enter with 10% of their full intended position size at $1,460. Let's say their complete position target is 100 shares. They start with just 10 shares. The stop loss sits at $1,420, just below the breakout level, giving $40 of risk per share. Shopify rallies over the next week. It doesn't go straight up. It has normal intraday volatility and minor pullbacks. But it holds above the breakout level and grinds steadily higher. Within a week, it hits $1,500. Now the stock has proven itself. It broke resistance, held the break, and extended higher. This is confirmation that the breakout has conviction behind it. You add another 20 shares at $1,500. Your total position is now 30 shares. Simultaneously, you move your stop loss up to $1,460, your original entry point. Think about what just happened. You now have a larger position, but your risk has actually decreased. Your first 10 shares are now risk-free because your stop is at break-even. Your second batch has risk, but it's being financed by the unrealized profit from the first batch. The stock continues to prove itself over the following weeks. It consolidates briefly around $1,500, builds a small flag pattern, then breaks higher again. It hits $1,600. You add the final 70 shares at $1,600, bringing your total to 100 shares. Your average cost is 100. 1,016 plus 2015 plus 716 culped 100. 1,600 plus 3 do plus 112,000 100. 1,566 1,566. Your average entry is $1,566. Your stop loss now sits at $1,500, protecting the bulk of your gains. You've built a full position with minimal risk. If the initial probe had failed and stopped you out at $1,420, you would have lost $400 on 10 shares. But because the stock proved itself at each stage, you were able to pyramid into strength, building your full position with your average cost well below the current market price. This is the core maxim you must burn into your trading Dina. Enter light. Add on strength. Cut fast if wrong. The 1-hour golden cross is your entry trigger, not your conviction signal. Conviction doesn't come from your analysis or your opinion about the company. Conviction comes from the stock proving itself through price action after your entry. If the stock proves itself by holding the breakout and extending higher, you add more shares. If it fails to hold, if it immediately reverses and breaks back below the breakout level, you cut the entire position without hesitation. No debate, no hope, no stories about why it's just a temporary pullback. Most amateurs destroy themselves not because their setups are terrible, but because their execution is reckless. They size too big on the first entry because they're excited about the setup. When the stock pulls back even slightly to retest the breakout level, they panic because their position is oversized. They have no room to add because they're already fully committed. They sell at the first sign of trouble, often at the exact bottom of a normal, healthy pullback. Then they watch in agony as the stock turns around and rips higher without them. They had the right idea, the right setup, even the right entry timing, but their position sizing destroyed the edge completely. The amateur thinks, I've done my analysis. I'm confident in this setup. Therefore, I should bet big to maximize my profits. The professional thinks, I've done my analysis. The setup looks excellent, but the market might disagree with me. Therefore, I'll bet small and let the market tell me if I'm right before I commit serious capital. One approach is ego-driven. The other is reality-driven. One One leads to boom and bust cycles of big wins followed by devastating losses. The other leads to steady, compounding returns over time. If the stock fails to hold above the breakout level within 3 to 5 days, you cut the position immediately. The 1-hour golden cross gave you a high probability entry signal. The stock failed to confirm that signal through its subsequent behavior. The setup didn't work this time. You lose small and wait for the next opportunity. This is exactly how Livermore made millions while others went broke, trading the same markets. He was willing to be wrong. He expected to be wrong frequently. But when he was wrong, he lost small amounts that didn't damage his capital base. When he was right, he pyramided aggressively into confirmation and made multiples of what he risked on the losers. The mathematics of trading success are straightforward. If you risk $1 to make $3 and you're right 40% of the time, you're profitable long term. But if you risk $3 to make $1, even if you're right 70% of the time, you'll eventually go broke. Position sizing and risk management determine whether you survive long enough for the probabilities to work in your favor. The probe entry protocol solves the fundamental problem every trader faces. You cannot know in advance which individual setups will work. You can identify high probability structures, wait for perfect confirmation signals, and enter with excellent timing, but you still cannot know with certainty whether this specific trade will succeed. The probe entry lets you participate with limited risk while preserving the majority of your capital for adding to positions that prove themselves. You're not trying to hit home runs on every swing. You're trying to get on base safely, then steal second, third, and home as the market shows you it's safe to be more aggressive. But there's one final critical piece of this system. You now know how to identify the daily structure, how to time entries with the 1-hour cross, and how to build positions through disciplined pyramiding. But you still need to know when to exit, because holding winning positions too long is just as destructive as entering losing positions too early. The market gives clear signals when trends are exhausting themselves, and if you ignore those signals, you'll watch your carefully built profits evaporate. That's the final layer of professional execution we'll cover next. Knowing when to enter is half the game. Knowing when to exit is the other half. But here's the brutal reality most traders never accept. Exits determine your profitability far more than entries ever will. You can have the world's best entry system, nail perfect timing on every trade, and still go broke if you don't know when to take profits. Most traders spend 90% of their energy perfecting entries, and maybe 10% thinking about exits. Then they wonder why they can't compound capital. Amateurs hold too long because they mistake hope for strategy. They enter a position, watch it go massively in their favor, and suddenly the plan disappears. A stock is up 25% for them. They know they should take something off the table, but greed whispers seductively, "What if this is the next Tesla? What if it doubles from here?" So they hold, watching their unrealized gains swell their account balance, feeling like market geniuses. Then the stock pulls back 10%. They tell themselves it's just a healthy pullback. All trends have pullbacks. The fundamentals haven't changed. The story is still intact. It pulls back another 10%. Now they're getting nervous, but they refuse to sell because they had huge profits once. They can't bear to lock in gains that feel small compared to what they almost had. The stock continues to fade. Soon they're back at break-even, then underwater. The winner has become a loser, not because the market was unfair, but because they had no exit discipline. Professionals operate with ruthless exit discipline. They take profits when the tape tells them the trend is losing steam, not when their emotions start screaming. They understand that trends don't end with announcements or headlines. The market doesn't send you an email saying the party is over. Trends exhaust themselves gradually through subtle shifts in behavior that whisper before they shout. Your job is to hear the whispers and act before the shouting begins. The 1-hour golden cross gives you precision entry timing before the crowd sees the daily signal. The 1-hour death cross, where the 50-period moving average crosses back below the 200, gives you the ultimate exit warning. But here's the critical distinction that separates professionals from sophisticated amateurs. You do not wait for the death cross to actually print before you start closing positions. If you wait for the formal death cross, you're making the same mistake as traders who wait for daily golden crosses. You're using a lagging indicator to exit a trend that is already reversed. By the time those moving averages actually cross, the stock has typically fallen 20 to 30% from its highs. You've given back a massive chunk of your carefully earned profits while waiting for mathematical confirmation of something the tape was already telling you weeks earlier. Instead, you watch for 4 specific signs of exhaustion that precede the death cross. These signals are not hidden in complex algorithms or secret indicators. They're visible in basic price action and volume patterns if you know what to look for and have the discipline to act on what you see. First, watch when the stock stops making higher highs. This is the most important signal, and the one amateurs ignore most consistently because it conflicts with their emotional attachment to the position. In a healthy uptrend, price creates a rhythmic pattern of higher highs and higher lows. Each rally pushes to a new peak, confirming that buyers are willing to pay progressively higher prices. Each pullback holds above the prior low, confirming that sellers are not overwhelming the market. When this pattern breaks, when the stock rallies but fails to exceed the prior high, the internal structure of the trend has changed. Buyers are no longer willing to pay up aggressively. Supply at that resistance level is absorbing demand. This doesn't mean the stock will immediately collapse, but it means the easy money phase is over and the risk-reward has shifted unfavorably. Second, watch the slope of the 1-hour 50-period moving average itself. During strong trends, this line points upward at a steep, consistent angle, acting as dynamic support. Pullbacks to the 50 are bought aggressively by institutions and algorithms. The stock bounces cleanly and resumes its advance, but when the trend begins to exhaust, the 50 starts to flatten. The angle decreases from steep to moderate to nearly horizontal. This flattening tells you that the average price over the last 50 hours is no longer rising meaningfully. Time is passing, but price isn't advancing. That's the mathematical definition of momentum loss. Third, watch volume patterns with obsessive attention. Volume is the fuel that powers every sustainable trend. In healthy advances, volume should expand on rallies as institutions accumulate and contract on pullbacks as they simply stop buying temporarily. This pattern confirms that moves higher have conviction while moves lower are just natural profit-taking or consolidation. But when trends exhaust, this relationship inverts in a way that screams distribution. Volume dries up on rallies, meaning fewer participants are willing to chase the stock higher at these elevated levels. The big institutional buyers who powered the early stages of the trend are no longer accumulating aggressively. Simultaneously, volume spikes on pullbacks, meaning more participants are rushing for the exits when the stock shows any weakness. This volume divergence between price and participation is often the most reliable early warning that smart money is changing its behavior. Fourth, watch how the stock behaves around the 1-hour 50 during intraday dips. This behavioral analysis separates professionals from amateurs who only look at end-of-day closing prices. In the early and middle stages of strong trends, the stock will bounce cleanly off the 50-period moving average. It might touch the line briefly during a pullback, but it immediately springs higher. Institutional algorithms are programmed to buy at these levels, creating consistent support. But in the late stages of trends, this clean support breaks down. The stock begins to pierce below the 1-hour 50 on intraday moves and struggles to reclaim it quickly. Instead of bouncing immediately, it chops around below the line, rallies back above weekly, then falls below again. The moving average that once acted as a springboard now becomes a magnet that the stock can't escape. This inability to hold above the 1-hour 50 during normal pullbacks tells you the underlying support structure is cracking. Jesse Livermore understood this principle of reading subtle shifts long before moving averages existed on screens. He didn't wait for the tape to scream at him that a trend was over. He didn't need a 50% retracement or a headline change to tell him to exit. He watched for what he called changes in the character of a stock's behavior. When a stock that had been making steady, powerful progress started to stall, when the rallies became labored and the pullbacks became sharp, he began lightening his position. He didn't exit entirely at the first sign of trouble, because he understood that even healthy trends have periods of consolidation, but he reduced position size systematically, locking in profits while giving the trend a chance to prove it still had legs. When the stock broke below a key support level that had held throughout the entire advance, when it violated the structure that had defined the trend, he exited entirely. No debate, no hoping it would bounce back, no rationalizing why this time was different. He respected what the tape was telling him. The line of least resistance had shifted from up to down. Let's return to the NVIDIA example to see exactly how this exit protocol works in practice. After the 1-hour golden cross triggered in February 2021, NVIDIA rallied from $600 to $800 by late March. The move was textbook perfect. Clean higher highs and higher lows. The 1-hour 50 sloping upward at a steep angle. Volume expanding on rallies and contracting on pullbacks. Every pullback was shallow and quickly bought. This is what a healthy institutional accumulation trend looks like. But in early April, all 4 warning signals began flashing simultaneously. The 1-hour 50 started to flatten, noticeably. Not dramatically, but the steep upward slope began to level off. The stock made a high at $840, then pulled back to around $800. A few days later, it rallied again, but this second attempt only reached $830. It failed to break the prior high of $840. That failure to make a new high was your first structural warning. Examine the volume on that second rally attempt to $830. It was significantly weaker than the volume that had driven the stock to $840 just days earlier. Fewer participants were chasing the stock at these levels. The institutional buying that had powered the entire trend was noticeably absent. Meanwhile, when the stock pulled back from $830, volume spiked. More sellers were active than buyers. The volume pattern had inverted completely. Finally, watch how NVIDIA behaved around the 1-hour 50 during this period. Instead of bouncing cleanly off the moving average as it had done throughout the entire trend, the stock began breaking below it intraday and struggling to reclaim it. The clean support that had characterized the entire advance was breaking down in real time. A professional trader watching these 4 signals would execute a systematic exit protocol. First, they would sell half their position immediately at $820, locking in substantial gains from the original entry around $600. That's a 37% gain on half the position. 600. 820 600. 600. 220. 0.367, 36.7%. Simultaneously, they would move their stop loss on the remaining half up to $800, just below the recent consolidation range. This ensures that even if they're wrong about the exhaustion and the stock resumes its trend, they're protected against any significant decline. The remaining position is now essentially risk-free because the stop is well above their average entry price. If the stock then breaks decisively below the 1-hour 50 and fails to reclaim it within the same trading session, they exit the remaining half entirely. No hoping it will bounce back. No waiting to see if tomorrow brings better action. The trend has given clear signals that it's exhausted. You respect those signals and step aside. In NVIDIA's actual case, the stock chopped sideways in a frustrating range for several weeks after reaching that $840 high. It didn't crash, but it didn't advance either. It entered what traders call dead money mode, grinding sideways while other opportunities emerged elsewhere. The professional who exited at $820 and $800 had their capital free to deploy into fresh setups. The amateur who held on, hoping for just one more leg higher, sat in a non-performing position for weeks, eventually getting shaken out at lower prices due to boredom or fear. Here are the explicit rules you must follow without exception. When the 1-hour 50 flattens and the stock fails to make a new high within 5 to 7 trading days, take half your position off the table immediately. This is not a suggestion for when market conditions feel right. This is mechanical execution of a proven protocol. You are paying yourself for a successful campaign and protecting against the inevitable exhaustion that follows every trend. When the stock breaks below the 1-hour 50 decisively and fails to reclaim it within the same trading session, exit the remaining position entirely. Don't wait for the daily death cross to confirm what the 1-hour chart is already telling you. By the time daily moving averages roll over, you could give back 20 to 30% of your profits while waiting for lagging confirmation. The mathematical advantage of this approach compounds dramatically over time. The 1-hour golden cross gets you in early, before the crowd recognizes the daily trend. The 1-hour exhaustion signals get you out early, before the crowd realizes the party is over. This timing advantage on both ends allows you to capture what professionals call the meat of the move, typically the middle 60 to 70% of any trend. Most traders think the goal is to maximize every single trade. to squeeze every last dollar out of every move. That's ego talking, not mathematics. The actual goal is to capture the middle portion of trends repeatedly and consistently. Let someone else fight for the exact bottom and the precise top. You take the easy part, the obvious part, the part where the probabilities are heavily skewed in your favor and the risk is minimal. This approach requires you to leave money on the table sometimes. Nvidia eventually went much higher months after that April consolidation. A trader who sold at 820 missed subsequent moves to over $300 by late 2021. But they also missed the drawdown. They also avoided the psychological torture of watching profits disappear during the consolidation. Most importantly, they preserved capital and mental energy for other opportunities that emerged while Nvidia was chopping sideways. You cannot catch every move in every stock. You cannot hold through every consolidation hoping it resumes. The opportunity cost of dead money is enormous in markets that offer dozens of fresh setups every week. You must make peace with the fact that you'll sometimes exit too early. That's the price of disciplined risk management, and it's a price worth paying. The alternative is holding too long, giving back profits, and turning winners into losers. That price is far higher and far more destructive to both your account and your psychology. The trader who captures 20% moves repeatedly will compound wealth faster than the trader who occasionally captures 50% moves but gives back 30% on average due to poor exit discipline. The 1-hour Golden Cross system now gives you a complete framework for systematic profit extraction. The daily structure tells you which stocks are coiled and ready to explode. The 1-hour cross tells you precisely when to start building positions. The probe entry and pyramid protocol tells you how to size properly and add to winners. And the exhaustion signals tell you when to harvest profits and move capital to fresh opportunities. This is not guesswork. This is not hope-based trading. This is systematic observation and disciplined response to observable market behavior. You're not predicting what will happen next. You're responding to what is happening now. When the market shows you strength within proper structure, you participate. When it shows you exhaustion and character change, you step aside. That's the entire game. Everything else is noise, ego, and rationalization. Now you have the complete technical system for timing entries and exits with mathematical precision. But there's one final element that determines whether you'll actually execute this system consistently under pressure or abandon it after the first few losses that challenge your ego. That element is not technical. It's psychological. It's the fundamental identity shift from amateur guesser to professional operator. Without that shift, even perfect technical knowledge will eventually fail when emotions override discipline. That's the final piece we'll cover next.